It's a pleasure to be here, and I would like to thank the organizers for selecting our paper to the program. The paper is co-authored with Zahi bin David from Ohio State University and Francesco Franzoni from University of Lugano. And in the paper, we try to shed the light on how ETFs increase the volatility of the stocks in their basket by increasing the exposure of those stocks to high turnover or high frequency investors, and thus amplifying the propagation of liquidity shocks to those stocks. In highlighting this phenomenon, we try to emphasize or stress on the importance of arbitrage as the channel through which these shocks are propagated. So since most of us are ETF investors, I would like to start with a more positive kind of tone to say that ETFs is a success story of innovation in finance. Nobody can undermine the numerous benefits that they bring to the table for retail investors and for more sophisticated institutional investors. They allow investors to access different markets at a very cheap cost with different portfolio exposures. And they are cheaper than mutual funds. They have more tax efficiencies. And most importantly, because they trade on an exchange and they are very liquid, they are very appealing to sophisticated investors who want to use them for speculation and hedging purposes. So in our paper, we are not trying to build a case on, against ETFs. Our evidence is merely about some unintended consequences that lead to the propagation of these non-fundamental shocks and increase the noise in financial markets. And we believe that such unintended consequences can be better addressed once they are properly documented and understood. So if we look at the growth in ETF in recent years, since they were introduced by State Street in 1993, they exhibited phenomenal growth. The growth accelerated in 2006. Now, if you look at the blue line, this is the number of ETFs on US exchanges. You see around 1,500 ETFs in the US with a total AUM of $1.5 trillion. So on average, in recent years, the ETF as overall, not only equity ETFs, all ETFs, they consist around 5% of total equity market capitalization. Globally, there are around 5,000 ETFs. And along with this growth comes more heated trading. So we noticed that ETF consistently, especially after 2008, they exhibited around 20% at least of the trading volume in US equity markets. And in some periods, it increased to more than 40% to 45% on average, in the few months when there are some market turbulence in 2010. So this highlights the fact that ETFs attract a different clientele, on average, a higher turnover clientele than average stocks in the equity market. And in this paper, we argue that because ETFs are more liquid, because they are much cheaper, they attract these high turnover clientele that trade, following their own kind of demand needs. So they create more kind of noise trading and turnover in the stocks in the ETFs themselves. For example, there are hedge funds and HFTs that find ETFs appealing for speculation, for arbitrage, or for different types of hedging needs. And this exhibits not only in high trading volume, but also in excessive short interest. In some occasions, short interest in ETFs can be up to 4 times the shares outstanding. So all these things, highlight the consequence of ETFs in equity markets. We find that because of ETFs, the structure of demand in securities have changed because of this continuous intraday arbitrage and because of the volatile flows, in and out of ETFs because of institutional investors' demand. So all this has raised concerns to regulators about the possible hidden risks, that are associated with ETFs. The liquidity risk was highlighted in the flash crash of May 6, 2010, and it was an important thing because we'll talk a little bit more about it later. 2/3 of the canceled trades during that period were ETFs, and they faced a lot of kind of liquidity dry-ups. So this raised concerns about how much liquidity risk is associated with that. In addition to the fact that synthetic ETFs, which are more prevalent in Europe, they have more counterparty risk. And all this led regulators to kind of raise concerns about how much ETFs lead to a buildup in systematic risk, especially in cases of unanticipated runs on ETF assets or on cases when the short squeeze, there is a short squeeze or high short interest unraveling, how much this would lead to kind of a more effect on the market stability in general and whether there are some threats associated with that. So in our paper, what we do is that we answer some of these questions, and we address the regulatory concerns by exploring whether ETFs increase volatility of underlying securities by amplifying their exposure to liquidity shocks via the arbitrage channel. And to do that, we first look at whether ETFs attract some new clientele that wouldn't invest in these stocks otherwise. And what we do here is that we focus on we look at the volume of these stocks, and we look at, we try to see if there is a significant change in the type of investors that invest in these stocks due to increased exposure to ETF. And then our main evidence is about the ETF stock ownership effect on stock volatility and turnover. And what we do here is we try to identify this relationship, and in a way that we can infer that there is a causality that happens between the two. We run a battery of tests to try to document that, and most importantly, we look at whether this effect is purely an intraday phenomenon or whether it survives in daily returns and in daily volatilities. And most importantly, we look at that, we dissect the arbitrage channel itself. So we wanted to see whether it's through arbitrage that this is happening, these shocks are propagating. So we look at various proxies for arbitrage, and we see that it's actually this kind of arbitrage trading that's transmitting the shocks from the ETF due to high turnover clientele to the underlying stocks themselves. So to pick at our results, we first look at the rate of incidence of liquidity shocks to the stocks, and we say that it's likely to have increased because of higher ETF ownership. So an increase in ETF ownership would lead to higher stock volatility and turnover. And we conclude that ETFs increase the volatility of and turnover of underlying stocks by exposing them more to the demand shocks, the non-fundamental demand shocks of the high turnover clienteles of ETFs. And then we zoom in at the arbitrage channel, and we try to see if this effect, the ETF stock ownership effect on volatility and turnover, is magnified by various proxies of arbitrage opportunities. And what we find is that the higher the arbitrage opportunities, the higher the flows, the lower the cost to arbitrage, the stronger the effect of ETF ownership on volatility and turnover. So we conclude that volatility and turnover, they increase on days when arbitrage is more likely to occur. Also, we try to run a specific test to make sure that we are capturing non-fundamental shocks and not only price discoveries that some might argue it happens in ETF because they are more liquid and they are cheaper. So what we do here, we look at the price pressure due to arbitrage. And we look at the ETF mispricing on day T. If the mispricing increase, if there is a premium, we expect that because of arbitrage, arbitrageurs will step in to buy the NAV so that they arbitrage away the mispricing. So it will cause a price pressure due to arbitrage on the NAV at day T plus 1. However, if this is a non-fundamental shock, it should revert in the following days. So we find evidence on such reversal in the following days. So we can conclude that this is actually the first trigger of these volatility shocks are actually due to, at least in part, non-fundamental shocks to the underlying stocks. Why this is important? We believe that this is, at least it fits in the recent literature and debate about whether high-frequency volatility is beneficial to long-term investors. And we relied on an SEC concept that clearly states how wary the SEC and the regulators in general about high-frequency volatility and whether they push out the long-term investors from the market. They clearly state that excessive short-term volatility may indicate that long-term investors, even when they initially pay a narrow spread, are being harmed by short-term price movements that could be many times the amount of spread. And actually, if we look at recent reports by the SEC and the Department of Treasury, especially like the flash crash investigation, there are a couple of reports that looked at that. As we know, the markets dropped within 20 minutes by about 6%, the S&P 500, and it was caused by Waddell & Reed trying to liquidate their 75,000 E-minis. So the joint report highlighted the fact that many of the securities experiencing the most severe price dislocation on May 6 were equity-based ETF. 2/3 of the canceled trades were ETFs. And if we look closely at the relationship or the price movement second by second during these 20 minutes, we noticed that the SPY was moving more closely with the E-minis. And it was leading the movement, the drop especially, and then the recovery of the S&P 500 index or the NAV, which kind of raised doubts on whether ETF facilitated the propagation of the liquidity shock from the futures market to the equity market. And this actually was confirmed in a September 2013 report by the Department of Treasury, who concluded that exchange-traded funds may transmit or amplify financial shocks originated elsewhere. And they went further to argue that ETFs could potentially accelerate or amplify price movements in markets during market turbulence, thus reducing market liquidity. So our paper fits in this kind of literature and recent investigation that are, and research that are done by regulators in this area. I will start first by giving a brief introduction about ETFs, talk about the arbitrage phenomenon, and then we will go and see the results. So ETFs represent, basically any exposure, any portfolio exposure to, that trades on an exchange. They are very similar to mutual funds. The only difference is that they trade during the day, and they are organized as investment companies, as open-ended funds or unit investment trust. They are different than standard funds, than open-end funds, in that they trade during the day. So because they trade an exchange and they are subject to the demand and supply, the ETF price can deviate from the NAV, which is the price of the index or the total value of the stocks that they own. And unlike closed-end funds, they allow in-kind creation and redemption, depending on flows and on the mispricing. So the authorized participant can create new ETF shares or redeem them, which basically will make sure that the ETF prices are tied by arbitrage to the NAV on longer horizons. So in our paper, we focus on physical ETFs, those ETFs that actually hold the shares of the underlying. We exclude synthetic ETFs. And we will go one step further. We exclude non-equity ETFs, so we focus on the ETFs that we can get their actual holdings from regulatory filings. So the ETF primary market is made primarily by authorized participants that are typically investment banks and brokers. When there are flows in and out of ETFs, this induces share creation and redemption. So the ETF shares are created in kind. The authorized participant, they collect the underlying securities, they give them to the ETF sponsor, like iShares or Vanguard, and they get ETF creation units. In exchange, there is a cost associated with that. It's very minimal. Like, for example, for one creation unit of SPY, I think it costs 3.9 basis points, and it decreases the more they issue creation units. Sometimes, most of the time, creation units are on 50,000 ETF shares, but some ETFs can have a creation unit of 400,000 shares or 100,000 shares, depending on the ETF. So we argue that authorized participants have incentives to exploit discrepancies between the price of the ETF and the NAV. And what they do is that they create and redeem shares to profit from arbitrage opportunities. So this ensures that the price of the ETF is kept in line with the NAV because of this intervention by authorized participants. This is an example of ETF arbitrage. If we have an ETF premium where the ETF price is higher than the NAV, this will create an opportunity for authorized participants to buy the underlying security, short sell the ETF shares, then take the underlying security, give them to the ETF sponsor to get the ETF shares, and then use the new ETF shares to cover the short ETF position. In efficient markets, because both assets have the same claims, the same cash flow claims, the same fundamental value, ETF price should be equal to the NAV up to the transaction cost involved with that. So the profit for the authorized participant is simply the ETF price minus NAV minus the transaction cost. The ETF discount and the redemption occurs in totally the reverse way. The authorized participant buy the ETF, short sell the underlying, they redeem the ETF shares in kind, and they cover their stock positions. So arbitrage can also happen in the secondary market when high-frequency investors and hedge funds, they take, during the day, they take long, short positions in ETF and underlying. and they wait for price convergence, they close the positions, and they realize the arbitrage profits. In some strategies highlighted in Petahisto paper and other papers, they might use futures and other ETFs instead of buying the underlying, and then they wait for the price convergence so they can reap the profits. So in real life, we argue that arbitrage is risky because execution is not immediate and mispricing might persist. We also argue that it's a limited arbitrage in the sense, we build on Greenwood 2005 that arbitrageurs, they have shorter horizon, they have limited risk-bearing capacity, so they can't wait too long for price convergence because it will expose them to non-fundamental risk. So what they do is that they hedge their positions by using the underlying, and in the moment they hedge the position, they are transmitting the shock from the ETF market to the underlying securities. So here comes our hypothesis about the shock propagation with limited arbitrage. We assume that both ETF and the NAV in equilibrium, they must have the same fundamental value. They must be at the same level. So, and then we observe some non-fundamental or exogenous demand shock that hits the ETF because of these high turnover clientele. It pushes the price. An example of that is like an institution receiving inflows, big inflows, so they scale up their ETF positions. It pushes the ETF price up. This will create a premium, a potential opportunities for arbitrageurs to step in and make profit out of that. So arbitrageurs, they short sell the ETF because they have limited risk-bearing capacity. They can't wait too long for the ETF price to correct. So what they do is that they hedge by buying the NAV. In the moment they do this hedging strategy, the shock propagates or is transmitted from the ETF to the NAV. If we stop here, some might argue that, well, you might be describing a price discovery that happens in ETF because they are more liquid. So, a necessary condition that we need to have is that both the ETF and the NAV, once liquidity flows back to the market, they both revert to the original fundamental value. So this reversal is an essential, condition that we need, to show evidence on it to make sure that we have a non-fundamental shock that happens, or as the initial trigger to the ETF price, rather than a price discovery happening in ETF market in the first place. So when we look at the literature, our paper is, the mechanism that of shock propagation is very similar to Greenwood risk-averse arbitrageurs, and we address the liquidity spillovers by Cespa and Foucault by showing that it's actually, this transmission mechanism happens through arbitrage. We look at the volume that is associated with that, and we show that there is an increased volume, which is kind of this is the stamp of the actual arbitrage, that's the transmission mechanism. And our paper is related to recent literature on the impact of institutional flows and asset prices, expected returns, and return co-movement. In specific, Wurgler, Sullivan, and Schong, they looked at how index-linked investing, it exacerbates return co-movement and distort the cross-sectional risk-return trade-offs, increase the beta, and there's a convergence in the beta in the stocks that are member of a particular index. So, which is highlighted very nicely in Bashak and Pavlova paper, the asset class effect, and they also argue that there is an index effect that causes, because of increased institutional demand, causes an increase in the return and the volatility of the members of the index. In recent periods, ETF literature picked up, so there are lots of papers that confirmed our findings about the fact that increased ETF ownership has led to some increase in the volatility in the market. Some evidence looked at the settlement failures, but most interestingly, a recent paper by Dai and Shive, it looked at the ETF, the relation between ETF ownership and the excess co-movement of basket stocks, and they found that increased ETF ownership leads or causes an increase in the co-movement of the stocks that they own, and this is a direct implication of our finding. We argue that when ETF ownership increases, it leads to increased volatility because of exposure to these liquidity shocks through the ETF clientele and arbitrage. If we take this argument one step further, because the same the stocks in the same ETF basket, they are subject to the same shocks. So this not only will increase the volatility of those stocks, but it will increase their variance, their covariance as well, which which makes sense. In terms of increased movement in general that's associated with ETF ownership. So in constructing our sample, we relied on CRISP and CompuStat to identify the ETFs. There are 1,600 ETFs during the entire sample period. And we used the CRISP daily return to compute monthly volatility. Then, we subset this universe of ETFs to focus more on the US equity ETFs that are most liquid, and we were able to find 660 US equity ETFs that we focus on in our study. For the shares outstanding, because the change in shares outstanding is basically our measure of net flows, we explored several sources, and we, after confirming with BlackRock and their iShares department, we concluded that Bloomberg has the most accurate and correct daily updated shares outstanding. CRISP, all the other databases, they lag by 5 days up to a month, so they are not reliable to be used for this kind of measure. We use the constituents of Russell and S&P 500 on a daily basis. And this is the universe we focus on because most of ETFs operate within these two kind of universes. The ETF holdings, we got them from Thomson Reuters, and we used the market security finance database to get the 7-day average landing fee, which is our proxy, one of our proxies of limits to arbitrage or the cost of arbitrage that we use to corroborate the arbitrage evidence in the paper. When we compute the mispricing of ETFs, which is basically the ETF price minus the NAV divided by ETF pricing, we make sure that all prices are aligned at 4 p.m. Some ETFs might clear 15 minutes after the market closes, or maybe later or earlier. So we make sure that we get the ETF price at 4 p.m. from TAC, and we compute daily stock volatility using the second-by-second returns. We use the trade prices and NBBO, and the results are the same. And we focus our sample to the period when ETF have significant ownership, which is basically after 2000 to 2012. So this is descriptive statistics that shows the growth of ETF over time. Since 2005, ETF ownership have increased threefold. So the average ownership of ETFs in firms is on average in our sample 1.9%. In 2012, it's about 3.8% of S&P 500 stocks, and similarly 3.8% in Russell 3000 stocks. We see momentum in the flows and the growth of ETFs. So after 2010, we find it interesting that the flows into equity ETFs is much higher than the flows into equity mutual funds. This is a chart from the ETP landscape, which is a publication by BlackRock, and it shows you the flows into global equity ETP in 2013. So you will see that it is much higher than the global equity mutual fund flows, and this pattern, we could easily observe it after 2010. So in our paper, we argue that ETF ownership increases the exposure, of the underlying stocks to these high turnover investors. And in constructing the ETF ownership, we make sure that we do it in a way that is independent of the factor that affect volatility and turnover. So our measure eventually is exogenous or does not depend on the factors that affect our variables of interest. And to do that, we construct ETF ownership on a daily basis using the weight of stocks in each ETF basket and the daily updated AUM, or total market capitalization, of each ETF. So when you multiply those, you get the total dollar volume of this ETF, the total dollar ownership of this ETF in that particular stock. We sum across ETF to get the total dollar investment by ETFs in that stock, and we scale it by market cap. So we believe that the cross-sectional variation is, independent of volatility and turnover. And the reason because, the same stock can have different weights in various indices. So it can be held by multiple indices and multiple ETFs. And because even if a stock is a member of a particular index, it might not necessarily be held by all ETFs because of representative sampling. That's like, for example, iShares follow this kind of approach. They don't hold the entire index, but they hold a subset of that index in their ETF portfolio. And we argue that also each stock can be owned by sector-specific or some specialty-based ETFs or active ETFs that hold a subset of these stocks. So, we believe that the variation across stocks is somehow exogenous. Also, add to that there is a time series variation in ETF ownership because the assets invested in ETF, they kept increasing or changing over time. You always have entry and exit, new ETFs coming into the market, some other ETFs liquidating their assets. So because of this, time series and cross-sectional variation, our identifying assumption is that the variation of ETF ownership is exogenous. To support that, we also include explicit controls for stock size and liquidity in all specification that you will see, going forward. And we also add stock and date fixed effects to capture, any time series variation or macroeconomic effect that are not captured by our controls. So our main argument is whether ETF increase the stock volatility and turnover, and we build on Amihud and Mendelssohn theory that high-frequency investors, they self-select in assets that are cheaper and that are more liquid. So we argue that because ETFs have higher liquidity and cheaper transaction costs, they attract high turnover clientele. The trading by these high turnover clientele, it impounds the liquidity shocks at a higher frequency in ETF prices, and it generates high noise trading. The underlying stocks, they inherit from ETFs those investors with high frequency trading due to the arbitrage activity. So as a consequence of that, we find that underlying stocks, they are subject, at a higher frequency to those liquidity shocks, which will increase their non-fundamental volatility. And we test whether this high frequency volatility survives on, over longer horizons. So in our first test, what we do is that for each stock in the S&P 500 and Russell 3000, we compute the intraday volatility, which is the standard deviation of second-by-second returns. And we regress that on ETF ownership in the previous period, and the log market cap, the control for size, and the controls for liquidity, 1 over price, Amihud, and bid-ask spread. We include the stock and time fixed effects, and we do the same by regressing the total turnover during the day over the same factors. So we are arguing that the increased ownership of ETFs will increase the exposure of those stocks to these, high turnover clientele, causing, more non-fundamental volatility that, for the underlying stocks. And we find that, both volatility and turnover, they have positive and significant, coefficients that load on the ETF ownership for both the S&P 500 and Russell 3000. So we conclude that ETF increases the intraday volatility of underlying stocks. For the extent of this increase, if we look at S&P 500 stocks, one standard deviation in ETF ownership leads to about 19% increase in standard deviation of intraday volatility, which is economically substantial. We find lower economic significance for smaller stocks, about 8% of standard deviation. And we argue that because arbitrageurs tend to rely on larger stocks when they, replicate their trading strategy to take advantage of arbitrage. Because they concentrate on larger and more liquid stocks to reduce costs, you tend to see more effect in the larger stocks than in smaller stocks. Turnover also increased, and the magnitude of this increase is about 19% of a standard deviation in turnover for stocks in ETF basket due to liquidity trading. So in testing whether the effect washes away in daily return, we do the same regression, but here we do it over monthly frequency. So every month we compute the volatility using the daily returns, and we regress it on the average ETF ownership and the various controls. It's also significant, and we conclude that this effect on volatility does not wash away in daily returns, which makes it more relevant for long-term investors that rebalance on a daily basis or even higher frequencies. So for S&P 500 stocks, we find that 1% increase of a standard deviation in ETF ownership, it leads to a volatility increase by 16% of standard deviation, which is about kind of 84% of the effect we saw in intraday returns. So we also found that the effect is less economic significant for smaller stocks, and we will look in more details about why this is happening in later tests where we look at cases when arbitrage is more costly. So how this effect supposedly will be weaker because the channel will be weaker. So we conclude that ETF are catalysts for demand shocks that affect underlying securities. And now we zoom in the arbitrage channel. And we look at, because arbitrage trades can occur in two different frequencies, we have two proxies for these, for this arbitrage channel. And the first one is the high frequency arbitrage that can occur continuously between the ETF and the underlying securities. Here we look at mispricing as the signal. So mispricing is simply the ETF price minus the NAV divided by the ETF price. So it's a signal for the profitability of the arbitrage trading. So what we do, we use this measure, which is for each ETF, and we construct a stock level measure. Because arbitrage can happen whether there is a positive or negative mispricing. We take the absolute value of this measure, we weigh it by the ETF ownership, and we sum over all ETF ownership so we can get an absolute ETF mispricing at the stock level. And we use that in the regression. We do the same thing for the low frequency arbitrage that supposedly happens at the end of the day when the authorized participant, they create and redeem shares. So to focus on the arbitrage activities by authorized participants, we look at the net flows, and we use that in a similar way to the absolute mispricing to compute a measure at the stock level. So we argue that this evidence, if we have evidence on a magnifying effect of mispricing and flows, this will be kind of a stamp that it's through arbitrage that these shocks are being transmitted. And the way how we do that, we regress the same intraday volatility and turnover on the ownership, the absolute ETF mispricing, and an interaction effect of the ownership and the absolute mispricing. And what we find is that the interaction effect is significant economically and statistically for larger stocks. And so it tells us that when mispricing is, when there are opportunities for arbitrage, when mispricing is different than zero, it causes a magnifying effect of ETF presence on volatility and turnover. So on average, for a stock that's owned by 1.9% of in terms of share outstanding by ETFs, we find that one standard deviation increase in mispricing leads to more than 85% of a standard deviation increase in intraday volatility and about 26% of standard deviation in turnover. However, we don't find that this effect holds for small stocks. We look at the flows as well, and we find here that it also has a magnifying effect on the ETF ownership, on volatility and turnover. When flows are different than zero, the trading and underlying securities increase. The authorized participants are buying or selling the underlying security, causing more volatility in the underlying security. And the magnitude of this increase is about 3.7% of a standard deviation and volatility for an average, for an ETF with average, for a stock with average ETF ownership. So we conclude that there is a weaker effect of flows than mispricing, because flows measure lower frequency arbitrage. But we find that flows effect for small stocks is stronger and significant. So now we build on a Greenwood paper to argue that in order to dismiss the fact that all these shocks are price discovery, if we can find that there are return reversals after this shock, we can conclude that at least in part, these shocks are due to non-fundamental increase in demand. So what we do is we first confirm the arbitrage activity by looking at price pressure due to arbitrage on the NAV immediately after the mispricing is observed. And we look at the ETF mispricing and flows at T-1 at the end of day T-1, and we look on whether it predicts the movement of the NAV because of arbitrage in the next day. So if this is the case, we conclude that there is actually a demand pressure on NAV due to mispricing, arbitrage, and flows. And then we look at the following days whether we can see any reversal. And we argue that the price pressure and the NAV reversal, if it is proportional to ETF arbitrage, to ETF ownership and arbitrage, this is kind of a stamp that it's actually a non-fundamental shock that's happening in the first place. And what we find by regressing the return of the S&P 500 at T on the ownership and mispricing at T-1, that there is an effect, a positive effect. So if there is a premium, for example, it leads to an increase in the NAV at T+1, and then a reversal afterwards which is consistent with the fact that arbitrage is actually propagating non-fundamental shocks. So when mispricing is positive and when flows are positive, we find that because of arbitrage, because of this kind of trading, the NAV increases in the following period and then reverting back in the multi-horizon period afterwards. Finally, we try to look at in cases when there are more costs associated with arbitrage, whether this effect is weaker. Because if arbitrage is a channel, then we can expect that for stocks that are harder or more costly to arbitrage, the effect of ETF presence on volatility and turnover should be weaker. So to do that, we use two proxies for limits or costs to arbitrage. The first proxy is the bid-ask spread, and the reason is because when an arbitrageur or authorized participant is involved in a arbitrage trade, they have to incur the cost, the round-trip cost of such trade, which is basically the bid-ask spread or the transaction cost. And the other transaction costs, it involves more with the short selling activities when they do that. So we use the stock lending fees. The higher the stock lending fees, you'd expect that there is less effective short selling involved with that, and subsequently, less heated or lower arbitrage activity. And what we do is that we compare the stocks that have high versus low cost to arbitrage, and we split the sample by low versus high bid-ask spread, low versus high stock lending fees, and we see how the impact of ETF ownership on volatility and turnover is affected by that. So here, the same regression as before. We have the S&P 500 stocks and Russell 3000 stocks. We regress the intraday volatility for two samples, the guys with the low arbitrage costs and the guys with the high impediments to arbitrage. And what we find consistently that the effect of arbitrage is stronger when the cost to arbitrage are lower. So it corroborates our evidence that it is through arbitrage, or arbitrage is the channel through which these shocks are being transmitted to the underlying securities. The evidence holds for both, the mispricing channel and the flows channel, and it's consistent with earlier evidence that smaller stocks being more subject to limited arbitrage because typically they have higher lending fees and they are more difficult are more costly to trade. So we argue that when arbitrage is more costly, the impact of arbitrage proxies on volatility and turnovers are reduced. When we use the lending fees, we find similar evidence in the sense that the guys that have higher lending fees, they exhibit a weaker effect of ETF ownership on volatility and turnover. So we argue that when arbitrage is less likely, ETF ownership does not increase volatility as much for the same level of mispricing or flows, which is consistent with our conjecture that arbitrage being the driving factor. In conclusion, we argue that financial innovation and ETF in particular, they cause higher level of noise or non-fundamental volatility in financial market. And we argue basically that, even though ETFs are one of the most successful innovations in finance, but typically, these new instruments, they create dense networks of arbitrage relations among different securities and asset classes, which will facilitate rapid transmission of liquidity shocks across assets, and this will manifest itself in increased volatility and turnover, non-fundamental volatility in financial markets due to the arbitrage channel. And we conclude that ETF ownership effect on stock volatility persists in longer frequencies, which has an impact on long-term investors. Thank you. I look forward to your questions and to the discussant comments.